Aarati Krishnan and you're watching A to Z of stock market investing. Today we'll learn L for listing gains. How would you like it if a stock that you own jumped 300% in a single month? Sounds impossible, right? But this did happen in the Chinese stock market, where stocks between January and May, newly listed IPOs, made a 300% listing gain in the first month. This does not happen often, but it can happen when the IPO markets are in bubble territory or in an overheated conditions. You must be aware of how private companies get listed on the stock markets and why they do it. Basically, when a company starts out with a small business, the entire capital needs of the business are funded by the promoter or the entrepreneur. But as the company scales up and maybe becomes national, then it becomes very difficult to fund all its capital needs from the resources of one individual. This is why companies actually go public, get listed on the stock markets, issue share to common investors and get money in order to fund their growth needs. When companies sell their shares to the public through an IPO, the response to the IPO depends on how it is priced. So if the company is seen to be priced at a valuation that is cheap, then it can get a lot of response from investors and get oversubscribed. Whereas if the IPO is seen to be priced at a premium or seen as being too expensive, then the response can really dry up. Therefore, during the IPO process, the company's promoters usually get together with the investment bankers, merchant bankers, and also gauge institutional response and actually set an IPO price. So based on the IPO price that is set, the IPO is offered in the market and investors can subscribe to it. The offer can get oversubscribed or undersubscribed. Sorry, there's no surefire formula to make a listing gain. Typically, if a company that's coming out with an IPO is priced lower than others in the market or in the same industry based on traditional valuation metrics like the price earnings ratio or the price to book ratio, then it can make a listing gain once it is listed on the markets. Or if it is priced higher than the peers in the industry, it can make a loss on listing. If you know about this IPO of Wonderla, the amusement park operator, which came out with its offer in April 2014, the offer was priced at 125 rupees. This is the price at which shares were issued to various investors. But on the first day, actually the stock closed at a very high price of 157. That's a cool listing gain of 26%. How did this come about? Basically, there were no other listed amusement park operators in India and investors were very bullish about this business. That's why the stock was able to make a listing gain on day one. Basically, though the prices are set by bidding, we have a system called a book-built issue. In a book-built issue, the company is able to set a price band for the offer. So after consulting merchant bankers and institutional investors, typically the company will say the price band within which investors can bid. For the Wonderla IPO, the price band was 115 to 125. Because the offer was heavily oversubscribed, the offer was ultimately priced at 125 and it could make a listing gain even on top of this price. Not really, because some IPOs can make huge listing losses also. Do you remember the Reliance Power IPO which came out in January 2008? Basically, it was the largest Indian IPO at that time and the company raised a large amount of money from retail investors in order to put up power plants. But within a month of the offer coming out in January, the global financial crisis hit the Indian markets and stock prices simply tanked. So the IPO, which was actually issued at 450 rupees, when the stock actually came to list on the markets, it immediately fell to a price of 372 rupees on the first day. This left investors with a lot of losses. The company had to take band-aid measures to actually issue bonus shares to all the investors so that they would not lose out on the listing gains that they were expecting when they subscribed to the offer.